Hello, everyone, and welcome back to Synaptic Investing. Hope you're having a fantastic week and are ready for another depth dive.
Yeah, looking forward to this one.
Today, we're breaking down one of the real giants, a company that, well, touches almost everyone's lives in some way. Chevron Corporation, ticker CVX.
Absolutely. A household name, but maybe not always fully understood.
Exactly. On the surface, you see the gas stations, maybe the logo on a tanker. It looks like a solid, stable energy company. But the real question for us as long-term investors is this. Are there, hidden strengths or maybe even cracks in that fortress that the market might be ignoring?
That's the core of it.
Yeah.
What's really going on under the hood, that's what we're here to find out.
That's a massive question. And before we really dive into the details, just a quick note for everyone watching.
Right. For those who might want to act on these investing ideas, well, having a professional grade platform is pretty key. We use Interactive Brokers ourselves, and we've actually partnered with them to get our viewers a stock bonus when they sign up using our link.
So they get a bonus and they help support the channel at the same time. That link is right down there in the description, right?
That's right. And of course, if you find value in this kind of in-depth discussion, the absolute best way to let us know, and honestly, to make sure you get the next one, is to subscribe and like the video.
Yeah, it genuinely helps the channel reach more people. And if you have any questions about Chevron as we go, or even thoughts, please, manifest yourself down in the comment section. We do read them.
Definitely. Perfect. Okay, now let's really get into it. Pillar number one, the business model.
Right. Let's start with the absolute basics. What is Chevron, really? I mean, at its core, how does it actually make its money? Is it just drilling holes and selling gas, or is it more complex?
Oh, it's definitely much, much more than just drilling holes, though that's certainly a critical part, a very profitable part.
Oh, okay.
Chevron is what we call a fully integrated energy supermajor. Now, that sounds like jargon, but basically it just means it operates across, well, pretty much the entire hydrocarbon value chain.
The whole chain?
Yeah, from the moment oil and natural gas are found, like thousands of feet underground,
yeah,
all the way through refining it, transporting it, and getting those products, into your car's tank or to a factory somewhere. Chevron's involved at pretty much every step.
Huh. Okay.
And this isn't just about being big, though they are enormous.
Yeah.
It's a deliberate strategy. It's designed to create operational synergies, yes.
Yeah.
But maybe more importantly, to kind of mitigate the huge ups and downs you get in commodity markets.
Right. Oil prices are famously volatile.
Exactly. So
Yeah.
they structure it primarily into two core segments that work together. You've got upstream and downstream.
Upstream and downstream. Okay, let's unpack those. Is one sort of the main engine, the profit driver?
Yeah.
Or are they equally important?
Well, they're definitely interdependent. They need each other for stability. But the upstream segment, that is, without a doubt, the primary profit engine for the whole company.
Okay, upstream. That's the drilling part.
That's the exploration, yeah. Finding it, developing the fields, and actually producing the crude oil and natural gas. It's a business of just immense scale.
Right.
Requires staggering amounts of upfront capital, billions, often. Deep geological know-how, complex engineering. These projects can take years, sometimes decades, just to get going.
Wow, decades.
Yeah, multi-year, multi-billion-dollar bets, really. And their operations here are truly global. They have huge cornerstone assets in really important places.
Like where?
Well, right here in the U.S., you've got the Permian Basin in Texas and New Mexico, which is massive. And the Gulf of Mexico, deep water stuff, super important, low-cost domestic production.
Okay.
But then you also have these colossal international operations, like the Tengiz field over in Kazakhstan, one of the world's biggest producing oil fields, and huge liquefied natural gas, LNG projects down in Australia. These are just okay assets. These are truly world-class, long-life, low-cost sources of energy.
So upstream is finding and pulling the raw stuff out of the ground. Sounds expensive, sounds risky, like you said. How much does that actually contribute to their, bottom line?
You're right. It is expensive, and it definitely carries risks. Geological risks, finding nothing. Geopolitical risks, operating in tricky places. But the financial contribution, it's absolutely central to why someone would invest in Chevron.
Okay.
Just look at the numbers from, say, fiscal 2024. The upstream part brought in only about 24% of Chevron's total revenues.
It's only a quarter. Seems low for the engine.
Right. But here's the kicker, and this is where it gets really interesting. The combined segment earnings for the whole company were around $20.3 billion that year.
Okay.
The upstream business. It was responsible for a massive $18.6 billion of that.
Wait, hang on. 18.6 out of 20.3.
Yeah. Almost 92% of their total segment earnings came from that upstream part that only generated 24% of the revenue.
Wow. Okay, that's a huge difference. Less than a quarter of the sales, but over 90% of the profit. What does that tell you?
It tells you a few really critical things.
Sure.
First, yeah, the integrated model gives stability, but finding and crucially, cost-effectively, pulling hydrocarbons out of the ground, that is the main, almost the only driver of shareholder returns and profit.
Right.
That's the high margin part of the business. That's where having a competitive edge, especially low production costs, really, really shines. So pretty much every major decision at Chevron R&D spending, where they allocate capital, who they might acquire, it's ultimately aimed at feeding and optimizing that upstream engine.
Makes sense.
It just highlights why having those top-tier, low-cost assets is so incredibly vital and why they're constantly pushing technology to make those operations even cheaper and more efficient. It's just this relentless focus on getting the most profit out of those core E&P assets.
Got it. Okay, so upstream is the profit powerhouse, the high-octane fuel. What about downstream then? What's its role in this big machine? Is it just processing what upstream finds?
It's much more than just processing, though that's a big part. Downstream is the refining, the marketing, and the transportation side of the business.
So turning crude into gasoline.
Exactly. They take that crude oil, sometimes their own from upstream, sometimes bought on the market, and they process it in these huge, complex refineries. Turn it into gasoline, diesel, jet fuel, you name it.
Okay.
But it also includes making things like lubricants and petrochemicals, too, often through joint ventures like their Chevron Phillips chemical company.
Right, plastics and things.
Yeah. And then, really importantly, it's about getting all those finished products to the market. That means a vast global network, pipelines, ships, storage terminals, and yeah, the Chevron gas stations you see on the corner.
The logistics must be insane.
Oh, it's incredible. Think about moving billions of barrels of product across continents, getting it exactly where it needs to be right when it's needed. It's a huge, complex operation.
And financially, how does downstream compare to upstream? Does it bring in big profits too, since it's, closer to the customer and handling all that volume?
Financially, downstream is almost the mirror image of upstream. The high-volume business, definitely.
Yeah.
But it's much lower margin.
Lower margin.
Yeah. So, back to fiscal 2024 again. Downstream generated the lion's share of the revenue, about 76% of the total. On the surface, it looks like the bigger part of the company.
Right, 3/4 of the sales.
But it contributed a much, much smaller slice of the earnings, only about $1.7 billion.
Only $1.7 billion, compared to $18.6 billion from upstream.
Exactly. So most of the revenue comes from downstream, but almost all the profit comes from upstream.
Okay, that feels a bit weird on the surface. Most sales, tiny profit.
Yep.
Why set it up that way? Is there some strategic brilliance I'm missing? Or is it just how the industry works?
No, this is where the real strategic genius of that integrated model kicks in. This is why it's so powerful, why they do it this way.
Okay.
It acts like a structural hedge, a natural shock absorber against that price volatility we talked about.
How so?
Think about it. What's the main cost for a refinery? The downstream business. It's the price of crude oil, their input.
Right. Makes sense.
So when crude oil prices are high, maybe during an economic boom or some geopolitical crisis flares up, the upstream guys are making massive profits, record profits sometimes.
Okay.
Now, those high crude prices might squeeze the margins for the downstream refineries because their raw material costs more, but the huge profits from upstream more than make up for that pressure. The overall company earnings stay strong.
Ah, okay, so one offsets the other.
Exactly. And now flip it. What happens when crude oil prices crash, like they did in, say, 2015 or early in the pandemic?
Upstream profits must fall hard.
They do, sometimes sharply. But in that exact same scenario, who benefits? The downstream segment, their main input cost, crude oil, just got way cheaper.
Ah, so their margins expand.
Precisely. Their margins get healthier.
Yeah.
So this inverse relationship, the seesaw between the two segments, creates a much more stable, much more predictable financial performance through the whole cycle than you'd ever get from a company that only does exploration or only does refining. It provides this crucial floor under the company's cash flow. It's like a built-in stabilizer. When one part is weak because of prices, the other part tends to be stronger.
So it's not just a random collection of businesses. It's actually engineered to handle the storms of the market. And why does that matter so much? For us looking at it as a potential long-term investment, What's the real payoff?
The payoff, the tangible benefit of that stability is that it's the key reason Chevron can maintain and critically reliably grow its dividend.
Ah, the dividend.
Yeah, that streak.
Mm-hmm.
They've managed to increase their dividend payment for 37 years in a row.
37 years. That's pretty incredible in any industry, let alone energy.
It really is. Think about what that means. What kind of company, in a sector known for booms and busts, can consistently raise its payout for almost 4 decades? Through multiple oil price collapses, financial crises, demand shocks.
Yeah, that's resilience.
It speaks volumes about the business model, the management discipline, the quality of the assets, and for you, the investor. It means a more predictable, growing stream of income. Even when the headlines about oil prices are all over the place, it shows they really understand their business and they are committed to returning cash to owners.
That dividend record really is something. And it leads perfectly into the next big topic, the economic moat. What really protects a company long term? So for Chevron, what is it? What keeps competitors at bay and allows them to keep making good profits? What's the secret sauce in their fortress?
Yeah, the moat. That's always the core question, isn't it? Chevron's fortress, its moat, is really built on a powerful mix of things. First, just sheer scale, which creates natural barriers. But maybe even more importantly, it's their portfolio of really advantaged low-cost assets.
Low-cost assets.
Exactly. Now, some analyses might just call their moat narrow. But if you really dig into their core upstream business, especially what I'd call their crown jewel, well, you see characteristics of something much wider, much more durable.
Okay, so what are the layers?
The first layer is just what we call efficient scale. The global energy business, especially the integrated supermajors, it's kind of a natural oligopoly.
Meaning only a few big players?
Pretty much.
Yeah.
Because the barriers to entry are just unbelievably high. Probably higher than almost any other industry.
Like what kind of barriers?
Think about it. To compete with Chevron, you'd need to fund deep-water drilling projects costing billions, taking maybe a decade to pay off. You'd need to build world-scale refineries, tens of billions each. And then you need the massive global logistics network. Pipelines, supertankers, storage depots.
Right. Not something a startup can just disrupt.
Exactly. The capital required is just staggering. It's prohibitive for anyone new. So this structure limits the real competition to just a handful of these other supermajors. And that insulates them, to a degree, from the kind of disruption we see in tech or retail. It allows these well-run giants like Chevron to earn decent returns on huge amounts of capital over very long periods. You can't just build another Chevron overnight with a clever app.
Okay, so it's a tough club to get into. But within that exclusive club of supermajors, what gives Chevron its specific edge? Is there one thing, one asset, that really sets them apart even from the other giants?
Yes. Their secret weapon, the absolute foundation of their competitive advantage today, is their position as a low-cost producer. And that status is anchored almost entirely by their massive, strategically crucial assets in the Permian Basin.
Ah, the Permian. We hear a lot about that.
And for good reason. This isn't just another field in their portfolio. It is truly Chevron's economic fortress. It's their main engine for future growth and the key to their resilience against low prices.
Why the Permian specifically? What's special about their position there?
What's special is how they got it. It's not something they just bought recently when shale became hot. A lot of their position comes from legacy holdings, stuff they've owned for decades. Yeah, way back, which gives them access to just a huge inventory of reserves that are very high quality and critically very low cost to extract. This is a huge distinction because many of their competitors, especially the European majors who maybe pivoted harder towards renewables earlier, they largely missed out on locking up these kinds of top-tier shale assets at scale. Chevron's foresight, or maybe just historical luck, gave them this unparalleled position in arguably the most important oil region in the world right now.
So legacy holdings mean they maybe got it cheaper or have access to the best rock. And what does low cost actually mean in practical terms? Is there a number? Why is that the key metric?
It means resilience. That's the bottom line. The critical number is their estimated break-even cost for producing oil and gas from these Permian assets. It's believed to be below $45 per barrel.
Below $45. Wow. Oil prices haven't been consistently that low in a while.
Exactly.
Right?
Think about what that means. Even if crude prices fell significantly from where they are today, way below $45, Chevron's Permian operations are still generating positive free cash flow.
Okay, that's huge.
It's absolutely critical in a commodity business. Like we said, oil is oil. A barrel from Chevron isn't inherently different from a barrel from someone else. So in that kind of market, the producer with the lowest cost structure always wins in the long run. Always.
They're the last one standing.
Precisely. They can keep making money when others are struggling, losing money, maybe even going bankrupt. This low break-even gives Chevron a level of economic toughness and strategic options that very few global companies can match. It means they can keep investing, keep paying the dividend, maybe even buy distressed assets during a downturn when everyone else is just trying to survive.
That is a powerful position, knowing you can thrive when others are just surviving. But are they just sitting on this advantage? Or are they actively trying to make it even better, widen that cost moat?
Oh, they are absolutely not just sitting still. They are actively widening that moat. They're doing it through aggressive use of technology and just relentless operational focus.
Like what kind of tech?
Well, for instance, they're leaders in using digital twin technology. These are basically virtual replicas of their oil fields, their reservoirs, their equipment.
Virtual models.
Yeah. They allow Chevron to run simulations, predict how wells will perform, optimize drilling plans, all without actually having to spend money drilling a physical well first. It de-risks things.
Right.
And they use machine learning, AI, to crunch massive amounts of data from their operations. This helps them find tiny efficiencies, ways to drill faster, use less water, less energy. They estimate these tech applications have improved their capital efficiency in the Permian by over 20%.
20% is a big number.
It's huge.
Right.
And this constant drive to lower costs isn't just, nice to have. It's the absolute core of maintaining a durable edge in a commodity business. And the Permian isn't fading away either. They expect their production there to grow by another 25%, up to 1.2 million barrels of oil equivalent per day by 2030. That secures a very long runway of profitable growth, directly fueling those shareholder returns.
So, okay, this low-cost Permian engine, how does it connect back to the dividend and the overall financial strength you mentioned? How does this specific advantage directly help us, the investors?
It creates this incredibly powerful, self-reinforcing loop for the whole company. You could call it a virtuous cycle or maybe a flywheel effect.
A flywheel.
Yeah.
Yeah.
The low-cost production from the Permian generates superior cash flow. And crucially, it's a reliable cash flow, not just when prices are high, but through the whole cycle.
Okay.
That cash flow then directly funds the company's main financial goals.
Yeah.
Number one, that consistently growing dividend we talked about.
Right.
Number two, substantial share buybacks, returning cash to owners.
Right.
These shareholder-friendly actions, in turn, attract investors who like that stability and income long-term holders, which helps support the stock price, and it also allows them to maintain that fortress balance sheet, keeping debt really low.
And the strong balance sheet.
That strong balance sheet gives them the financial muscle to make smart strategic acquisitions when opportunities arise, like the Hess deal they're working on now. Buying Hess adds even more low-cost, high-quality assets, this time in Guyana.
So it all feeds back into itself.
Exactly. It's a beautiful cycle. Premier assets generate strong cash funds, dividends, and buybacks. A&D maintains low debt. Low debt allows buying more premier assets, which generates even more cash. It just keeps strengthening the core business and boosting returns for you, the shareholder.
Beyond the hard assets, the oil in the ground, the low costs, are there other, maybe softer advantages? Things that add to Chevron's moat but aren't quite as obvious on a spreadsheet?
Oh, absolutely. There may be secondary to the cost advantage, but Chevron's intangible assets definitely play a role.
Like what?
Well, the brand itself, the Chevron brand, is recognized globally. That helps, especially in their downstream business, the gas stations, the lubricants. It supports some pricing power, builds customer loyalty.
Do we know how loyal their customers are?
Yeah, there's data on that. Their Net Promoter Score, or NPS, which basically asks if customers would recommend them, is plus 30.
Is that good?
It's quite good for the sector. It's notably higher than competitors like BP or ExxonMobil, who are both around plus 19, suggests a stronger connection with their end users, which means repeat business, resilience.
Okay, brand recognition.
What else? Decades and decades of experience. Think about the sheer complexity of the projects they undertake. Deepwater drilling, massive LNG plants, intricate refineries, global logistics, executing those successfully, safely, efficiently, year after year. That builds up this incredible reservoir of proprietary know-how.
Institutional knowledge.
Exactly. Technological expertise, operational excellence, safety protocols, managing huge, complex projects, kind of deep, ingrained knowledge built over generations of engineers and operators. It's incredibly hard and expensive for anyone else to replicate. It's not just about having the money. You need the skilled people and the proven processes.
It sounds like they have a lot going for them, tangible and intangible. You often bring up mental models, those frameworks from investors like Munger and Buffett. How does Chevron fit into those? Does it align with how they think about great businesses?
Oh, absolutely. Connecting it to those models really helps crystallize the investment case. Let's start with Buffett's idea of the circle of competence.
Okay. Staying within what you know.
Right. And Chevron's management team seems to have a very clear, very disciplined understanding of their circle. Their whole strategy revolves around what they do best: finding, producing, refining, and marketing hydrocarbons efficiently.
How does that show up?
Look at how they're approaching the energy transition. Instead of making huge, risky bets on, say, offshore wind farms or something totally unrelated where they have no edge, they're focusing on adjacent, lower carbon opportunities.
Like what?
Things like renewable fuels, biodiesel, sustainable aviation fuel, hydrogen production, carbon capture and storage. These are things that leverage their existing assets, their pipelines, their chemical processing skills, their experience managing complex projects and moving molecules globally.
So play into their strengths.
Exactly. It's fascinating self-awareness. They're not chasing headlines. They're building logically on what they already do well. That's sticking to your circle.
Okay, what other models apply?
The big one, maybe the most important for Chevron, is the low-cost producer advantage, which Charlie Munger talked about constantly.
We touched on this with the Permian.
Right. In a business selling a commodity where the product is basically undifferentiated, the company with the lowest structural costs is the only one truly guaranteed to survive and thrive through the inevitable price cycles.
Makes sense.
Chevron's fortress in the Permian, with that sub-$45 break-even, that is the physical embodiment of the low-cost producer advantage. It ensures they can make money, return cash to you in almost any environment. It's the ultimate competitive weapon in this kind of market.
Okay. Circle of competence, low-cost producer.
Yeah.
Any others?
Yes, the Lollapalooza effect, another Munger concept.
Lollapalooza. Sounds fun.
It refers to when you get multiple factors, multiple advantages, all working together in the same direction, creating a result that's way more powerful than just adding them up individually.
Synergies on steroids.
Kinda, yeah.
Yeah.
And Chevron's integrated model is a perfect example. You've got 1, the low-cost upstream assets, especially the Permian powerhouse. 2, the downstream segment acting as that stabilizing hedge against price swings. 3, that disciplined, shareholder-focused management allocating capital wisely to dividends and buybacks. And 4, the rock-solid balance sheet providing financial flexibility.
Okay, those 4 things.
Put them all together. They reinforce each other. And the result is this exceptionally resilient, cash-generating machine that's built to endure, built to deliver consistent returns through thick and thin. That's the Lollapalooza effect, creating a really powerful investment case.
That brings us neatly to the people in charge. We can talk about a great business model, great assets, but management matters hugely, right? Even the best business can be fumbled. So, how's the stewardship at Chevron? How are Mike Wirth and his team doing?
Yeah, crucial question. And this is actually another area where Chevron tends to stand out. The leadership team under Mike Wirth has shown, I think, a remarkably consistent and disciplined hand on the tiller.
Disciplined how?
Their financial priorities aren't just vague goals. They state them clearly, repeat them often, and most importantly, their actions match their words year after year.
What are those priorities?
That's pretty simple hierarchy, and it's very shareholder-friendly. Priority 1, consistently grow the dividend. Priority 2, invest capital efficiently, only in high-return, low-cost projects. Priority 3, maintain that fortress balance sheet, keep debt low. And Priority 4, return any excess cash left over to shareholders, primarily through share buybacks.
Grow dividend, invest smart, keep debt low, buy back stock. Seems logical.
Is logical. But sticking to it, especially through industry cycles, is the hard part. And that seems to be ingrained in their philosophy. It's not just a plan for this year. It feels like how they run the company, period.
Okay, that's the plan. What about the execution? Do they actually stick to it when things get tough or when oil prices shoot up and there's temptation to spend big?
The track record is really the proof here. And it's pretty compelling. Let's take the dividend again. That 37-year streak of annual increases, that's the ultimate testament to their commitment.
Right, through multiple crashes.
Exactly. Think about 2008, the financial crisis. Think about the oil price collapse in 2014-16. Think about the demand destruction during the pandemic. They kept raising the dividend through all of it. That signals it's a deep cultural priority. They know investors count on it.
Okay, dividend commitment. Check. What about investment discipline? Energy companies are famous for, spending like crazy when prices are high.
That's the historical trap, right? Pouring money into projects at the top of the cycle, only to get burned when prices fall. Chevron's management seems very consciously trying to avoid that.
How?
They've kept a pretty tight rein on capital expenditures, or Capex. They guided for $15 to $17 billion annually through 2026. And in 2024, they spent $16.4 billion, right in that range.
So no sudden splurges.
Exactly. And this discipline isn't just about hitting a budget number. It's what drives their massive free cash flow. It ensures they're only putting money into the very best, highest return projects, not just chasing volume growth at any cost. It's about efficiency.
Makes sense. And returning cash beyond the dividend. Buybacks. Lots of companies announce buyback plans, but do Chevron actually execute consistently?
They seem to view buybacks not just as something you do when times are good, but as a core, ongoing way to return excess cash.
How much are we talking?
Well, in 2024, they returned a record $27 billion total to shareholders. A huge chunk of that, $15.2 billion, was through buying back their own stock.
$15 billion in 1 year? How much stock is that?
That retired about 5% of their outstanding shares in a single year, which is pretty significant.
Yeah, that boosts earnings per share for everyone else.
Right. And it's not a one-off. Looking back, they've bought back stock in something like 17 of the last 21 years. That shows a long-term systematic belief that returning cash this way is good for shareholders, and presumably that their stock is a good value. They're not just hoarding cash or making dumb acquisitions with it.
Speaking of acquisitions, that Hess deal is huge. Does that fit the disciplined approach, or is it maybe getting caught up in M&A fever?
That's a fair question, given the size, but the Hess deal actually looks like a prime example of their discipline, precisely because of the assets Hess brings.
How so?
Hess's main prize is its stake in that incredible discovery off the coast of Guyana. It's considered a world-class asset, very long life, very high quality, and crucially, some of the lowest break-even oil production costs anywhere in the world.
Low cost again. Fits the strategy.
Exactly. It slots perfectly into their focus on high-grading the portfolio with advantaged assets. It's expected to boost Chevron's growth profile and cash flow significantly for years, maybe decades to come. It's not growth just for growth's sake. It's acquiring a specific top-tier asset that meets their strict criteria.
Yeah.
That feels very disciplined, not impulsive.
Okay. So this combination, the dividend focus, the Capex discipline, the big buybacks, the strategic M&A, what does it all add up to? You used a term earlier, anti-fragile.
Yeah, anti-fragile. It's a concept from Nassim Taleb. It means something doesn't just resist shocks or volatility, it actually benefits from them.
How does that apply here?
Think back to that 2014-16 oil crash. A lot of energy companies, especially those with too much debt, were in deep trouble. Cutting dividends, selling assets cheap just to survive, some went bankrupt.
Right.
For Chevron. With their low debt and strong cash flow, they could keep investing steadily in the Permian. They maintained their dividend growth. They could even look around to potentially buy assets from those weaker players at bargain prices.
So the downturn was actually an opportunity for them.
Exactly. They didn't just survive. They were positioned to potentially get stronger, gain market share, improve their asset base because of the chaos. That's anti-fragility. By keeping that financial firepower dry, management ensures that a crisis isn't an existential threat, but a chance to improve their long-term position.
So it's not just defense, it's the ability to play offense when others can't. How does that financial fortress look on paper? What are the actual balance sheet numbers like?
Well, the result of all that discipline is a balance sheet that really earns the fortress label, especially compared to others in the energy sector. End of fiscal 2024, their debt ratio was just 13.9%.
13.9%. That sounds low for a giant industrial company.
It is very low.
Huh?
And their net debt ratio, which accounts for cash on hand, was even lower at 10.4%. These are super conservative numbers for such a capital-hungry industry. And they're actually below Chevron's own historical levels. They've deliberately paid down debt over the last decade.
So the credit rating agencies must like that.
Oh, yeah. They get elite credit ratings.
Right.
AA from S&P, AA2 from Moody's. These are top-tier investment-grade ratings, the kind usually reserved for the most stable companies, or even governments.
And what's the benefit of that?
Access to cheap capital. It means they can borrow money easily and at very low interest rates whenever they need to. If markets get tight and other companies struggle to find financing or face high borrowing costs, Chevron can still access capital cheaply. That's another huge competitive advantage, especially in a downturn.
Okay, strong balance sheet, top credit rating. But it all comes back to cash flow, right? Are they actually generating enough cash? day in, day out to pay for the investments, the growing dividend, those massive buybacks? Is the engine really pumping out cash?
Absolutely. The underlying business is just a prodigious cash machine. Even in 2024, which wasn't a peak year for oil prices like 2022 was,
Right, more moderate prices.
even then they generated $31.5 billion in cash flow just from running the business, from operations.
31.5 billion. Okay.
Then they spent $16.4 billion on capital expenditures, maintaining assets, drilling new wells, funding projects.
So cash from operations minus Capex?
Leaves $15 billion in free cash flow. $15 billion.
15 billion free and clear. How does that compare to the dividend?
Their dividend payments that year were about $11.8 billion. So that $15 billion in free cash flow easily covered the entire dividend payment, with billions left over.
Billions left over for the buyback.
Exactly. This ability to completely self-fund all their investments and their growing dividend and still have significant cash left over for buybacks. That is the absolute hallmark of a financially powerful, resilient business. It's not just accounting profit. It's real cash piling up. And that cash flow stream is what fuels everything else we've talked about, the returns to you, the investor.
Okay, we've built a pretty strong case here. Robust business, great assets, disciplined management, financial fortress, huge cash flow. But no investment is perfect. We always have to look at the risks. And the future. What could go wrong? What are the big challenges, the opportunities, especially considering where the stock is trading now?
Right. Absolutely essential to look at the other side. Let's start with valuation. Where does it stand today, mid-2025?
Yeah, is it cheap, expensive, fair?
Well, looking at the forward price-to-earnings ratio, the PE, it's trading around 19 times earnings.
19. How does that compare historically?
It's actually quite a bit above its recent average. The three-year average PE for Chevron was closer to 12 times. So on that simple metric, it doesn't look statistically cheap right now. Might suggest the market is already pricing in some growth or quality.
Okay, PE looks a bit high. What about other metrics?
Other multiples look maybe a bit more reasonable. Price to book is around 1.8x, price to sales about 1.5x. Those are more in line with historical ranges and peers.
Any others that are particularly relevant here?
Yeah, for capital-intensive businesses like this, enterprise value to EBITDA. EBITDA is often a good one to look at. It includes debt, ignores some non-cash charges, gives a cleaner picture maybe.
And what's that number?
On a trailing basis, it's around 8.0x, 8 times EBITDA, which, again, for a quality company in the sector, doesn't scream wildly overvalued. It suggests the price is somewhat reasonable relative to its cash generation.
Okay. What are the Wall Street analysts saying? Do they see big upside from here?
The consensus is generally positive, mostly buy ratings. But their price targets suggest fairly limited upside in the near term, maybe the next 12 months.
How limited?
The average target seems to be somewhere in the $163 to $168 range. If the stock is trading around $150, $155 now, that's only maybe 5% to 10% implied upside. Not huge.
And does that line up with like intrinsic value calculations?
Yeah, it does. Various discounted cash flow models tend to spit out fair value estimates in that same ballpark, maybe $153 to $156 per share.
So putting it all together, sounds like it's trading around fair value. Not a bargain, not crazy expensive.
That seems to be the conclusion, yeah. Fairly valued. You're paying a reasonable price for a high-quality, resilient business, but you're not getting it on sale.
Okay, if it's not deeply discounted, where does that margin of safety come from? If the price itself isn't the safety net, what is? Is it just hoping the dividend holds up?
For a long-term owner, the margin of safety here is less about buying it dirt cheap today and more baked into the qualities of the business itself.
Meaning
Meaning the real safety net is the durability we've been talking about. It's the low-cost Permian assets acting as that buffer against low prices. It's the fortress balance sheet protecting against financial shocks. It's the integrated model smoothing earnings. This combination ensures the business is highly likely to survive and even thrive through whatever the future throws at it. That resilience is a form of margin of safety, even if you can't easily quantify it.
so a qualitative margin of safety built into the business itself.
Exactly, but there's a quantitative buffer too, and that's the dividend yield.
Right, the 4.4% yield.
Yeah. Getting paid a solid 4.4% return in cash just for holding the stock while you wait for its value to compound or for catalysts to play out, that's significant. Especially when that dividend is backed by 37 years of consecutive growth. It feels incredibly secure. It's like a patience premium. You get paid well to wait, and that yield is much higher than the broader market.
Okay, that makes sense. But even with those safety nets, what are the big, hairy risks, the things that could really derail the train, maybe permanently damage the company or its prospects?
Well, the most obvious one, always present, is just commodity price risk. Oil and gas prices are volatile, unpredictable. A deep, prolonged slump in energy prices, maybe from a severe global recession or some massive new supply source, would absolutely hit Chevron's earnings and cash flow, even with their low costs. No escaping that entirely.
Right, inherent to the business. What else?
The really big one, the existential one long term, has to be the energy transition.
The shift away from fossil fuels.
Exactly. The global move towards lower carbon energy is a fundamental challenge to their entire business model. If that transition happens much faster than expected, maybe driven by a breakthrough in battery tech or really aggressive global climate policies.
Then demand for oil and gas could fall off a cliff.
Potentially, yeah. And that risks stranding Chevron's massive reserves. Their main assets could become worth much less, or even worthless. That's the melting ice cube scenario.
And their investments in renewables, carbon capture, are those enough?
Well, they are investing, like we said, renewable fuels, hydrogen, CCUS. But right now, it's a small part of their overall spending and earnings. And the ultimate profitability, the scalability of those new businesses, it's still pretty uncertain. So the huge question remains, can a giant oil company pivot fast enough, effectively enough, to thrive in a low-carbon world? Or are they destined to shrink over time? It's the biggest strategic challenge they face.
Okay, energy transition is huge. What other risks?
There's always regulatory and political risk. This industry is constantly under the microscope.
Yeah, you hear about drilling restrictions, pipeline fights.
Right. Changes in environmental rules, new carbon taxes, limits on where they can operate. All that can increase costs or block growth projects. And because they operate globally, they're exposed to political instability in various places, maybe Venezuela, Nigeria, even places like Kazakhstan, where they have huge investments. Things like resource nationalism, contract changes, disruptions.
Geopolitical headaches.
Definitely. And then there's ESG and reputational risk.
Environmental, social, governance.
Yeah. Huge pressure from investors, activists, the public about their environmental footprint, climate change impact, past controversies, legacy issues in places like Ecuador, refinery incidents.
Right. That stuff can linger.
It can. And failure to manage it well leads to lawsuits, fines, makes it harder to attract talent, maybe even increases their cost of capital if investors start avoiding the sector. It's a constant balancing act.
Any other maybe less obvious risks?
One that's more subtle, maybe more internal, right, based on sort of informal checks, scuttlebutt, is around employee culture.
Culture? How so?
Well, Chevron historically had this strong reputation, the Chevron way, very focused on safety, operational excellence, maybe more employee-centric. Some internal chatter suggests maybe that's eroding a bit, becoming more bureaucratic, maybe losing some of that distinctive culture.
Why would that matter to an investor?
Because a strong, positive corporate culture is a real, though intangible, asset. If it weakens, it can make it harder to keep the best engineers and operators. It could lead, down the line, to maybe lapses in safety or problems executing complex projects efficiently. It's a non-financial risk, but one worth watching because operational excellence is so key for them.
Okay, those are definitely some significant risks to keep in mind, especially the energy transition. But let's flip back to the positive side. What are the potential catalysts? Things that could happen to really boost the stock, maybe surprise the analysts who see limited upside?
Yeah, there are definitely some powerful potential catalysts on the horizon, things the market might be underestimating. First off, Chevron is right on the verge of what looks like a major inflection point in its free cash flow.
An inflection point, meaning it's about to jump higher.
Exactly. They've had several massive capital projects under development for years. Think the Future Growth Project in Kazakhstan, big new developments in the Gulf of Mexico. These have been sucking up cash.
Right, investing phase.
Now they're starting to come online, ramp up production. They're shifting from being cash consumers to becoming cash generators, big time. That, plus the continued growth in the Permian, is expected to drive something like a $10 billion improvement in annual free cash flow over the next few years.
$10 billion extra free cash flow, that's huge.
It's a massive jump.
Yeah.
Really changes the financial firepower they have.
Okay, Catalyst 1, cash flow surge, what else?
Catalyst 2, successfully closing and integrating that Hess acquisition.
Assuming it goes through regulatory hurdles.
Assuming it closes, yes.
Yeah.
Adding those high-quality, low-cost Guyana assets will be a big boost. It's expected to add another $2.5 billion a year in cash flow, plus they're targeting $1 billion a year in cost savings, synergies from combining operations. That further juices profitability.
So Hess makes the numbers even better.
Significantly better, yes. Strengthens the whole portfolio.
Okay, Catalyst 3.
Third, It's the potential upside from those lower carbon businesses we talked about. It's small now, yes. But if they execute well, if they can successfully scale up things like renewable fuels or carbon capture,
It could become a real growth engine.
it could create meaningful new revenue streams, yes. But maybe even more importantly, it could lead to a re-rating of the stock by the market.
Re-rating, meaning investors value it differently.
Yeah. If the market starts to see Chevron not just as an old oil company, but as a more diversified energy company with a credible plan for the transition, that could attract different kinds of investors, maybe ones willing to pay a higher multiple for the earnings. That perception shift could be powerful.
Interesting. Okay. Any other catalysts?
Well, just the direct consequence of that surging free cash flow combined with their disciplined spending means there's going to be an enormous amount of cash left over for shareholder returns.
More dividend growth and buybacks?
Exactly. Continued dividend increases are almost certain, and they'll likely continue very aggressive share buybacks. That directly increases your return as a shareholder, reduces the share count, boosts earnings per share over time. If they keep delivering those returns consistently, it could attract more income investors, creating more demand for the stock.
Okay, so putting it all together, the business strengths, the risks, these potential catalysts, the valuation, what's the second level thinking here? What's the angle the market might be missing?
This is where you try to think differently from the crowd, right?
Yeah.
And a plausible thesis here is that the market is maybe too caught up in the day-to-day swings of oil prices and maybe too focused on those big, scary energy transition headlines.
And maybe lumping all energy companies together?
Possibly, painting all of big oil with the same negative brush. And in doing so, it might be underappreciating the sheer durability of Chevron, underappreciating the consistent cash generation from those low-cost assets, especially the Permian advantage.
And maybe missing that coming cash flow jump.
Could be. The market might not be fully pricing in that near-term inflection in free cash flow as those big projects finally start paying off. That's a tangible upcoming boost. And furthermore, the narrative often fails to distinguish between a best-in-class operator like Chevron, low costs, strong balance sheet, disciplined management, and some of their weaker peers who might have higher costs or too much debt.
So undervaluing the quality difference.
Potentially. Undervaluing the genius of the integrated model as that volatility buffer. Undervaluing the anti-fragile nature of the balance sheet that lets them play offense in downturns. So if you connect the dots, the second level thought is, the market might be pricing Chevron like it's just a generic, inevitably declining oil company, when in reality it might be better understood as a best-in-class, highly resilient energy producer with decades of profitable life ahead, run by a team laser-focused on shareholder returns. It's recognizing that not all oil companies are the same, and Chevron's specific advantages might be worth more than the market currently gives them credit for.
So, wrapping this all up, what does this deep dive mean for you, the listener? It seems like Chevron emerges as a really durable business. You've got exemplary management, you've got top-tier assets, and a clear strategy for returning cash to shareholders.
Yeah, that's a fair summary.
The valuation isn't dirt cheap, but it looks, reasonable for the quality you're getting, especially with that strong, growing dividend providing a nice cushion. You're essentially looking at a financially impregnable, well-run, low-cost leader in a vital global industry. It seems built to last, built for resilience.
I think that's right. But the investment thesis does rest on a few key pillars holding up. You have to believe hydrocarbon demand stays pretty strong for a good while longer. You have to believe management stays disciplined and doesn't make big mistakes. And you have to believe that Permian low-cost advantage really endures.
Right, those are the key assumptions.
So, to leave you with something to really chew on, try a red team challenge on yourself. Ask this: what would have to be true for Chevron to actually be a terrible investment from here, even with all the strengths we've laid out? What specific event, what trend, what management fumble could fundamentally break this business or destroy its advantages? What could kill the thesis? Exactly. Wrestling with that question is crucial for thinking critically about any investment, especially one in a sector facing such significant long-term change. Keep learning, keep questioning,